One important way to manage your risk in an equity portfolio is, of course, diversification. Diversification helps you across industries, across countries, right? So I have some money today invested in the US. I have some money invested in a fund called the Global Advantage Fund, which invests in countries abroad. So I have some money in US, some money in China, some money in Asia, Taiwan. These are countries in which I can never participate. So why should I be participating? Because the startup culture, startup and listed culture in Taiwan is better than that in India. How will I ever participate? So to bring that variety into my portfolio, I do invest, and that obviously has to come through mutual funds, because I don't have the capacity to assess individual stocks in Taiwan and all those places. So, and these are good markets, because these are markets where you get very good dividend yield. I was looking at some Taiwanese portfolio, the 7% kind of a dividend yield. So if I can get a 7% dividend yield, and in US dollar terms, that could not be too bad, right? So to invest abroad, to invest in the businesses which you just can't access to in India, right? To invest in countries which you don't have access to while investing from India, or you need huge amounts of money. These are nice for me to enter, which means I am entering equities in these countries through a mutual fund. I also tend to weigh my positions and as equally as possible, right? I don't want too much weight on financial services, too much weight on pharmaceuticals, and these things to me are a little scary. Pharmaceuticals look good at this stage, but I don't have too much of a position. But something like Sun Pharma, Lupin, Cadila, and all this, I've always had positions. So to me, it doesn't matter that the price is high or price is low, but they would always be there in my portfolio. But if I think pharma is doing well, I may go and put money in a healthcare fund or in a pharma fund, because I want to increase the weightage of pharma in my portfolio, and that is not possible buying individual stocks. It's far more difficult. If it's a very simple tactical allocation to pharma for 5 years or 3 years, I wouldn't break my head over which share more to buy. I mean, I can always buy more of Sun Pharma because it's already there in my portfolio, or best is to put money in a pharma or a healthcare fund and saying, okay, let me ride the boom, rather than taking the pain of selecting. These shares would anyway be there, they would anyway do well, right? Another important way how I control my risk is to make sure that I do not have more than 5% in one share in one company, and I do not have more than 10-15% in one industry, right? So that is also very important. So if I like financial services, it doesn't mean I'll have HDFC Bank, ICICI Bank, SBI, Cholamandalam, Sundaram Finance. When you keep buying all these shares, apart from say National Stock Exchange, or CAMS, or a couple of mutual funds, insurance companies, you realize that your weightage to financial services is far greater than the weightage to the financial services in the index. But remember, the index may as of now does not have a life insurance company, asset management company, right? So all this could come. So based on all that, I suddenly say, oh, if 30% of my portfolio is financial services, that's scary, right? So it will never go to that, but I have a 5% cap on how much should be there in one particular script, and I try to stick to that. The problem with that is, if a company is doing extremely well, it's very difficult to sell that share, but that is very important to sell. Like I said, if 66% return that I've got in Siemens and Cummins in the last 1 year, why would I not sell an extremely small position? Let's say 5% of my position. I've got 1000 shares. Why will I not sell off 50 shares? I may not talk of even 500 shares, but 50 shares is 5% of your portfolio. Why not cut your position by 5% in that portfolio? Yes, maybe infrastructure will do well, blah, 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 all that is true. But why not cut a position? So I do cut positions. So if I also realize that if I put 1 lakh in a share, the maximum I can lose is 1 lakh. But the opportunity cost of not investing in the share could be pretty high. So I'll just sometimes I stay here. I'm not very clear as to what I always do. I don't think I'm very consistent in what I do. That brings us to a very important thing as to how to monitor investments. For example, I have invested in the Murugappa group. Now there is nothing called the Murugappa group, they or the Sundaram group. They've all split among themselves. So each brother is holding one. So then knowing more details about the current management of a Carborundum Universal, knowing that the management of Carborundum Universal is different from the management of AID Parry, which is different from the management of Cholamandalam, which is different from the management of XYZ, right? So it's very important to know the differences. Then so that's very difficult, but yes, that's very necessary part of the monitoring that one does. One largely monitors by numbers, but one has to manage the qualitative factors also, not just quantitative that you can depend on totally. I do not look at my companies on a quarterly basis. I mean, what great thing is going to change in a Colgate or a HUL over every quarter? I just look at the results and say, wow, good results, wow, bad results. That's all. It does not really matter to me. But once in 18 months, I look at market share. Well, Patanjali is selling more toothpaste than Colgate, or whether somebody else is going to launch a toothpaste, or is Dabur doing better than Colgate. I keep looking at it, and then I'm not worried if the market share has slipped from 63% to 58%, because you know that 63% is difficult to sustain, and you know over 5 years, 7 years market share will fall. Then the question is, are the margins good? Are they able to do well in volumes? Because if the volume itself is expanding, then a fall in the market share doesn't really matter. Though I don't like the trend over a long period of time. I know I get good dividend yield, I know it will grow, I know it has got the ability to attract good talent, right? So all that being in place, I will not sell off Colgate. But yes, 18 months is when I look at the long-term trend. Maybe even 24 months to look at the long-term trend, and then to see whether these dividends are sustainable. What is going to happen? Is there something else which I can buy? Can I sell Siemens and buy BHEL? Can I sell Siemens and add more Larsen and Toubro? Or should I just forget infrastructure for a minute and go and buy the basics? Should I buy banking? Should I buy cement? Right? So looking at all those things. But if you have built a portfolio of good quality companies at attractive valuation, then I really expect to hold on to it for years. Like I said, Carborundum Universal now holding on for 23 plus 16, 39 years, right? So 23 plus 14, 37 years. So if you hold shares for such a long period of time, your dividend yield and all is guaranteed, decent growth, there is absolutely no reason to sell. So danger of monitoring on a regular basis is you feel tempted, oh, let me do this more often. Sometimes you feel like, sometimes you don't. And when I say sell, I largely mean switch. So let's say sell Siemens to buy Bayer, or sell Bayer to buy something else. So this is more a switch. Do I want to sell my Tata Power to buy something else, right? Those are the questions that one keeps asking. That also brings us to a very important thing as to when to sell a particular share. Do you just hold on permanently? To me, the answer is yes. I can hold on permanently. It doesn't really matter. So I can hold on for pretty long periods of time, simply because you are built a portfolio and you're adding on to it rather than trying to build a fresh. But I sell a company when I feel. So what are the reasons why I have sold shares? I've sold shares because it is getting merged into somebody else, some other company. It is being acquired, there is a change of management. I've also bought because there is a change of management. I had a very small quantity of Shanti Gears, which was anyway a listed company. Then when the Murugappa group I took a big position in that, and that's up 5x from when I took it at 65. It's now something like 350 or 380. Something like that. So yes, now I'm more willing to, it had very good management in the beginning. It's not to say that the Murugappa group has added value in terms of the management, but yes, they have added some value. And same thing for CG Power. I would never have touched CG Power. CG itself I don't like, and that to power industry I don't like, but I knew when the Murugappa group comes, they will add value to it. So this is a share, again I bought it in maybe at 40, and today it is 300 plus. So some of these things I have bought or sold basic on the change of management. When change of management happens, that company looks attractive or looks unattractive, right? So somewhere there is a fear that the management quality is not good. There are governance issues. I sold Biocon at 380, saying something is wrong. the ESG or something was not adding up, right? So some of these basis of sale. Largely when I say sale, I largely mean switch. Of course I could be sitting on cash for some time if I don't think the market itself is attractive, but that is again a switch, because the sale has not been done to use the money elsewhere. The sale has been done to sit in cash, to look for opportunity as to what to buy. If I can't buy something, I can stay on in an ultra short bond fund again for very long periods of time. If I don't have money in the sense to invest, if I don't have any big expense coming, there is no reason why it should be sitting even in a share which I want to anyway sell. So if I want to sell, I sell off immediately. I also sell to reduce my position, saying, oh my god, this jump is too much as a percentage of my position, so I sell. I may be buying it in my wife's portfolio, I may be selling it in my wife's portfolio and buying it in my daughter's portfolio or my father's portfolio or my mother's portfolio, right? So something else could also be happening, but largely yes, I do pair positions, I build positions. Sometimes I build positions aggressively. I also realize that I don't invest too much of money. I am not a mutual fund that has to build a 20,000 crore position or a 15,000 crore position in one company and they take a long. I invest every month whenever there is money. There is no great criteria as to when I invest, right? Whenever I see I have money, I invest. Whenever I think I need money, I disinvest. How does one try to improve as an equity investor? One, after building a portfolio, you tend to look back and say what has happened. Then this is something which is little tricky. I have several of friends whom I can call up and say, oh, how does this share look and how does this share not look, and somebody will say, oh, the results are coming in 4 days time. That is something which I can also gather, but it is easier to talk to some analyst who is doing it on a regular basis. Or somebody else will call and say, what do you think of this industry, what's happening? Some fund manager meet or some fellow investor, some chat. So all monitoring is not just by looking at numbers and saying why is this, but if a company cuts the dividend, then to me it's a very big red signal, because companies rarely cut dividends. They have a cushion, right? If somebody is doing a 30% to 60% of EPS kind of a payout, they have a full range in which they are doing. So they always do 30%. Sometimes when they are doing well, they do 45% or 50%. Look at Oracle Financial Services. It's a fantastic payout. So when there is a very good payout, you are hesitant to sell the share. But if there is a better opportunity somewhere, if you say, oh, anyway, I think software is going to do well, so why not shift from Oracle to Infosys or TCS or HCL, or say, oh, overall software is not going to do very well, so why not shift from Oracle to, say, State Bank of India, which is available at 500 rupees. Any of these things are possible. So to me, selling and buying are not necessarily connected. I may sell, sit on cash and then buy, or I may get a good opportunity and therefore to buy that, sell some share. So all these things happen, but looking at how to evaluate. So yes, there is the numbers evaluation, which is the qualitative evaluation, the quantitative evaluation. The qualitative evaluation largely happens because you are reading something somewhere and you say, oh, this is going to happen, or say this is not going to happen, or say, oh, the average price at which people are selling air tickets has gone up. Indigo will suddenly make more money because they're doing more foreign trips. So you pick up this data somewhere else, right? You're watching a YouTube video, you're talking about something else, some politics, and suddenly something else comes up. So all these things are evaluation. So do I do a very scientific and methodical evaluation? No, but I know a lot of analysts, so I speak to some analysts, and sometimes it is fund manager, sometimes it is analyst, sometimes it's some fellow investor. So some talk somewhere. All this is part of the evaluation process. Sitting and doing an evaluation can only be quantitative. Qualitative has to be reading. So those are the ways of doing evaluation and trying to improve.